markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey, what's up? Aaron Fifield here. This is episode 177, and I'd like to introduce to you a special guest of mine, Sam Bankman-Fried. Sam's trading skill originated from 3 years at Jane Street, a proprietary trading firm renowned for being one of the largest ETF liquidity providers in the world, and also renowned for their secrecy. In late 2017, Sam relocated to Hong Kong and began his foray into the cryptocurrency market when he co-founded Alameda Research. Alameda trade a range of quantitative strategies such as statistical arbitrage and market making, which are mostly automated but have a layer of human intervention. In less than 2 years, Alameda has grown to a point where each day it does approximately $1 billion of turnover and accounts for somewhere near 5% of global crypto volume. Sam and I got to discuss many aspects of how Alameda operate and how his team have found lucrative opportunity amongst a chaotic environment. The sound quality on this episode, it isn't perfect, so I do apologize for this. We did the best with what we had, and I'm sure once you get a couple minutes in, your ears will quickly adapt. Anyway, now on with the show. Let's get it going. Here is Sam for episode 177. I got to say, I really enjoyed that video you posted the other day. I think James, who is probably there somewhere close by, filmed that. That was really cool. That was
Thanks.
Nice. That was cool that you guys sort of shared that. I feel as though you don't really get insight like that very often. You know, like most trading professional market makers or like trading desks don't normally share that sort of stuff.
Yeah, it's pretty rare. I think that a lot of it's because of, IP sensitivity. People don't want sort of their trading secrets leaking out. And so, it's just generally a pretty secretive culture.
Yeah. And I mean, you didn't necessarily give away anything secretive. Like there wasn't really much to hide there, but it was just cool to kind of see you trading around a sort of a pretty interesting event like that.
Thanks. It was an exciting time. I mean, I think it's definitely the most exciting parts of the job are when trading gets busy. So
yeah, because there's certainly a lot of times where it's boring. Well, maybe not quite so many times in crypto.
Yep.
Yeah. So anyway, that was good. Now you as a trader, your training ground was at Jane Street, right?
Yep, that's right.
What was that experience like?
It was really nice. I think I had a great time there. They're very good to me. I guess I was in college at MIT, sort of didn't know what to do with my life, and I had some friends who had interned at Jane Street, so decided I'd try it out, and I liked it, so I went back full time after I graduated. It was a really nice environment, and I learned a lot there. There was obviously at the beginning a lot of just sort of learning the ropes, talking to other people. Learning how they thought about trading, and then slowly, expanding the amount of trading that I was doing, starting off with just, a pretty simple case, and then, eventually growing into, more and more products that I was, first helping out with, and then in charge of trading. But even the longer I was there, there's still a lot of communication with the other traders. It wasn't like I was sort of siloed off with my section of the universe or anything like that. It's a very collaborative and communicative environment.
And what products were you trading there? I take it wasn't anything crypto related?
No, it was not. It was international ETFs. So I was trading US listed ETFs that were sort of composed of non-US equities.
What does that mean? Say that again, sorry?
Yeah. So I guess, you can kind of sort of start at the beginning, which is what is an ETF? So, an ETF, an exchange traded fund, it's basically a mutual fund that also trades on an exchange like a stock itself. And so, if you buy a share of an ETF, what you're doing is you're buying a share of a company that has just bought shares of a lot of other companies. So, sort of the most standard ETF is called SPY. It's the S&P 500 ETF. And what it does is it just owns a little bit of each of the top 500 companies in America by market cap. And So if you buy, 100 shares of SPY, you're buying, a little bit of Apple, a little bit of Google, a little bit of Exxon, et cetera. So that's what an ETF is. And ETFs have sort of two different properties. The first is that, well, you can trade them on the market like a stock themselves. So if you want to buy a little bit of everything, you could buy 500 different stocks, or you could just buy some shares of SPY, and you're sort of synthetically getting exposure to the top 500 companies. And it also has a primary market mechanism called creations and redemptions, where basically you can actually just go to the SPY company and say, hey, I'd like to deliver, the 500 stocks, and they'll give you back some SPY. Or you could give them your SPY, and they'll give you back the stocks that it owned. So that's what an ETF is. I was trading U.S. listed ETFs, so ETFs that traded on, the New York Stock Exchange. But where the companies that they owned, rather than being Apple and Exxon, they owned, a Taiwanese semiconductor company, or Toyota, or Barclays. So they were U.S. listed funds that traded on exchange, but that owned foreign stocks themselves.
Okay, I'm with you. Interesting. And how long were you there for?
I was there for about 3 years.
Okay, and whereabouts? That was in the US somewhere?
Yep, that was in New York. So I was working on Wall Street there in their flagship office.
Okay. And so when did Alameda come about? And I am pronouncing that right, yeah?
Yep, Alameda. So Alameda came about in late 2017. I left Jane Street, and I liked it a lot there, and don't have any gripes at all. But I don't know. I guess felt like there were a lot of things I wanted to try doing in the world, and so I left, and shortly thereafter started exploring crypto, and it looked kind of crazy. You look at U.S. stock markets, and you're used to saying, "Oh, this thing's like maybe trading at the wrong price by 1/100%. Like, that's pretty weird." And then you get to crypto, and everything's multiplied by 50. It's like, oh, this thing, it's within 1%. And so it's just like wildly more volatile and dislocated than sort of U.S. stock markets were. And it seemed like, one of two things were true. Either all this data was fake and nothing was going on here. It's just like, this arbitrage is just some mirage, or it was an extremely exciting opportunity. And sort of started diving into it, and it quickly became clear that, about half the data was fake. But the other half was real. And in fact, there were some very exciting opportunities there. And in particular, there's a lot of customer demand for crypto, and just not a lot of liquidity being provided to it. And that was, dislocating a lot of the coins on a lot of the platforms and causing a lot of sort of arbitrage opportunities.
So up until this point, you hadn't really had any exposure to crypto?
That's right. I think I could have maybe explained roughly what a Bitcoin was, and that's about it.
Man, that's pretty crazy. That's a pretty bold move on your part to leave Jane Street and then sort of decide that, hey, I'm going to start a crypto trading firm.
Yeah, and it's definitely sort of a pretty, taking a leap of faith there, and a pretty exploratory move. I don't know. It seemed exciting. It seemed like, man, this could be really awesome. This could just be an unbelievably good opportunity, or there could just be nothing there. And if there's nothing there, that's okay. I've wasted a few months of my life, but I gave it a shot. And on the other hand, maybe this is like just a spectacular opportunity. And so it seemed like, even though I was pretty uncertain, it seemed like just the risk reward trade-off is pretty good.
Exactly, yeah. I mean, it kind of seemed as though you were almost looking for a new challenge.
Yeah.
So who did you start Alameda with? Like, how did you get together the team?
Yeah, so I guess I had a college friend who was bored as hell at Google as a software developer, who I sort of worked on some projects with and lived with back at MIT. And so I called him up, and he flew over to our fledgling 3-bedroom apartment / office. And started writing the code. And then I had, basically friends of mine from, various parts of my life, and then eventually friends of, the friends of mine that we'd hired, and we sort of just grew out organically like that.
Okay. And did any of these other people who you brought on, what was their kind of knowledge of this market like?
Basically, no one had any crypto knowledge. There were, where they come from, basically, software developers from Google and Facebook, and then quantitative traders from Wall Street who had never touched crypto before, and then some friends of mine on the operational side as well. But none of us had traded crypto before this.
Okay, fair enough. Now, a lot of people who are going to hear this podcast, the audience of Chat with Traders, obviously some of them are very active in crypto, but a lot of them aren't. And those who aren't are not going to be familiar with Alameda Research. So, just in a nutshell, before we kind of get into the nitty gritty, how would you describe Alameda? Like, what type of firm are you?
Yeah, so we're a quantitative cryptocurrency trading firm. We basically do, a combination of arbitrage-based trading, sort of quantitative signals and modeling, liquidity providing, and OTC trading across basically all of the major cryptocurrencies and cryptocurrency exchanges. And so, sort of the most basic thing you can imagine us doing is, well, on Coinbase, someone's willing to buy a Bitcoin for, $13,000, and on Bitstamp, someone's selling it for $12,900. So, we go to Bitstamp, we buy the Bitcoin, we send it to Coinbase, we sell it, and we've made $100. And, that's sort of the simplest arbitrage you can have in crypto. And 2 years ago, there's just a lot of that. There's a lot of really simple, large arbitrages. Over the course of the last 2 years, things have become a lot more competitive, a lot more efficient. And the trades that we're doing are more complex now. And so you can imagine, trades that involve multiple different exchanges at once, multiple different products all against each other, derivatives as well, and trying to understand the relationship between a future and the underlying. You can think about the various fiat currencies that are involved in crypto. And, you might think, oh, well, I can price Bitcoin against Japanese yen. You just multiply Bitcoin, Japanese dollar by, the FX exchange rate. But in crypto, nothing's what it seems. And a lot of these fiat currencies are only really sort of fiat currencies. And you look at, the kimchi premium, which is the, Korean Bitcoins trading at, as high as a 50% premium to the rest of the world. How can that happen? Well, the reason is, it was only sort of against Korean won. It was against this thing called Korean won, but you couldn't actually take it out of the cryptocurrency exchange and buy dollars with it and get those out of the country like you might have wanted to. And, the Korean won is itself sort of a restricted currency. And then you can look at, a lot of stable coins, which they're sort of US dollars, but sort of not. And maybe it's not free to turn them into US dollars. And so, there's a lot of things in crypto where you can kind of see arbitrage as a significant piece of how you think about them, but it's not just a Bitcoin or just a dollar. It's something a little bit more complicated and nuanced than that. And, over time, our trading has started to expand into more and more nuanced trades as sort of the most obvious ones have gone away.
Okay. So just kind of reading between the lines and going off some of the comments you've made there, it sounds like when you first viewed the crypto market, you saw that there were a lot of arbitrage opportunities to be had there. What were some of the greatest difficulties or, the challenges that you came across, maybe some unexpected issues once you actually started to dig a little deeper and you started to really get into things?
Yeah, it's super interesting because, you look at these, Coinbase versus Bitstamp arbitrage, and you're like, look, I don't need to know machine learning to do this. Literally, I'm just buying a Bitcoin for $12,900 and selling it for $13,000, and I just made $100. And so you can ask, well, how can that be? If it's that easy and anyone can see it, why is it still there? And the reason is, well, a lot of the reason is sort of the infrastructure. There's a lot of things you take for granted when you're trading U.S. equities. If you buy a share of Apple on the New York Stock Exchange and you sell it on NASDAQ at a higher price, you just made money, and you're done. You've successfully completed your trade. You buy a Bitcoin on Bitstamp and you sell it on Coinbase. Well, okay, you actually didn't have a Bitcoin on Coinbase. You had one on Bitstamp. So how are you selling on Coinbase? Well, I guess first you got to send the Bitcoin from Bitstamp to Coinbase. What if you can't withdraw from Bitstamp? What if you can only get $100 a day out of the exchange? And you start running into things like withdrawal limits, where, on a lot of exchanges, it's actually very difficult to do a large trade because you'll just get your money stuck. They'll severely rate limit how quickly you can withdraw any of your funds from the exchange. And so that can make it quite difficult to do one of these. What else happens? Well, as I said, let's say that, there's a Bitcoin trading against some stable coin somewhere. So a stable coin, it's a token that theoretically represents a dollar. But the key there is that theoretically, what makes it a dollar? Well, the only thing that would really make it a dollar is if you could just hand someone the token and get back a dollar. And you could hand someone a dollar and get back the token. But for a lot of stable coins, the way that you actually create these stable coins, maybe it's expensive. Maybe you have to pay 1% in order to create them. Maybe you have to pay 3% to redeem, or maybe you can't redeem. Maybe they just don't allow it. And now you're I don't know, I can buy a Bitcoin for $12,900, and then I can sell it for 13,000 stable coins. Is that good? Is that an arbitrage? Well, it really depends on what you're going to do with those stable coins. Do you have a way to turn those into dollars? Do you have the right account on the right platform to do it? Are you going to run into limits? Even if you can do it, they're going to send a wire transfer to your bank. Will your bank shut your account down? It turns out that if you go to Bank of America and you're hey, we're a bunch of 20-year-olds, get this cryptocurrency trading startup. We'd like to send lots of wire transfers to a lot of international businesses. And yes, this is Bitcoin trading, to be clear. They're going to be no, you're the worst client that we've there's just no way, right? Imagine the anti-money laundering, know your customer risk for them there. They're so we can't track anything you're doing, right? Not only can we not track it, it's not even happening on US platforms. And so now you're well, okay, I thought I had this arbitrage, but now my bank account got shut down because I tried to do the arbitrage. And you kind of keep layering things like this on top of each other. And what you realize is that really the devil's in the details here. And that even a simple looking arbitrage can become quite complex operationally. And what you have to do is you have to have great accounts on the exchanges. You have to understand exactly what you can and can't do, how much you can get in and out. You have to understand the time that it takes to move a coin around the blockchain. You have to have a bank account that's willing to work with you and work with the platforms that you need to use. You have to have the capital to do these trades. You have to figure out how are you hedging any positions that you're putting up there in a realm where you can't short sell on most venues. And you have to take into account, risk associated with, hacks in crypto. And these things, they just keep piling on and on and on. And in the end, what you realize is actually there's just an enormous operational endeavor involved in really understanding all of the different platforms and products in crypto, and that a lot of the trades that look really easy, they're not really there. I mean, they're there, but you don't make money doing them because you didn't realize you're paying a percent of fees somewhere in this chain.
Is that part of the reason why you've set up shop in Hong Kong as opposed to the US?
It's a good question. And we're a global firm. We attempt to be active on all of the major platforms, trading on 30 plus platforms, trading $1 billion a day and trading a bunch of different coins. And in order to be able to do that, you have to be able to access from a lot of different jurisdictions, right? You need to be able to access the US exchanges, the Chinese exchanges, the Japanese exchanges, Korean exchanges, the Caribbean exchanges, European exchanges. And all of a sudden it's some countries just say, yeah, whatever, anyone can trade on this. But others are no, you need a real setup here. And so one thing that we had to put a lot of work into was developing, kind of a global corporate structure where we have entities in a lot of different jurisdictions. We have bank accounts in a lot of different countries. We have employees in different countries. And sort of over time, our business just became more and more global. And it became clear that we needed serious operations in a lot of different places. So that was one thing that was happening. And then the other thing is that over time, we've become increasingly client-facing. At the beginning, we were just a proprietary trading firm. We never talked to anyone from the outside. But we now have an OTC desk where customers can come and trade against us 24/7. We also recently launched a derivatives exchange called FTX in crypto. And for both of those, customer relations matter. And at this point, where is most of crypto happening? It's not in the States, it's in Asia. And so it also kind of became clear that, if we really wanted to have relationships with our customers, the place to be was, well, at least somewhere in Asia. And then why Hong Kong? Well, and to be clear, we do have operations in multiple places in Asia, but we thought about a bunch of different things here, including like what's centrally located, where is the bulk of crypto happening, what's the relationship of the country like to the important jurisdictions in crypto, and how easy is it for foreigners to get to set up shop there, and sort of all of those combined together when we're kind of trying to decide where we should be expanding and centering ourselves.
Yeah. Now that certainly seems like an enormous effort to be able to trade on. I think you said it was either 30 or 35, of the top exchanges.
That's about the number. Yeah. It's taken an enormous amount of work, on the operational side, getting these, entities set up and these banking accounts, but also just the dev side. Like you have to connect to 30 different APIs, and, maybe many of these APIs are total shit. Like these are not good APIs. These are APIs that just like don't have something. It's like, they just like don't tell you your open orders, and you're like, all right, well, how am I going to trade if I don't know my open orders? Or they won't give you a history of your fills, and you're like, oh God, like what's going on here? And
what's my real position?
We have to find exactly right. Like, and you have to find ways to get data that you trust, and that's a non-trivial engineering task when you don't really always trust the source of data to give you what you kind of think they should be.
Yeah. So I guess the natural question would be, why was it important for you to be active on so many exchanges? Like, what advantage was that to you?
Right. So the basic answer is that there are two ways to think about, what exchange you would choose. One, if you think of yourself as a liquidity taker, is my goal is I want to get long Bitcoins. I just want to buy a bunch of Bitcoins, right? And that's what you're saying. Then first of all, it doesn't matter that much where you buy them. But to the extent it does, you just have to find the one or two exchanges where you can find the best liquidity, where you can buy everything you need without having much impact, without paying large fees, and that it'll interface nicely with your systems. Another version of it, though, is like, I'm a liquidity provider, and my sort of role in crypto is to be on the other side of those trades, and to take advantage of arbitrage opportunities that arise because of customer demand. And so a lot of how we think about our trading is not like, we're just going to buy a lot of Ripple today. What we're thinking about is like, where do we see imbalances in supply and demand? Where do we see a ton of customers trying to buy some asset and not enough liquidity? So the price is running up there, maybe more than it's running up in other places. So it creates an arbitrage opportunity, but only if you're able to sell where the customers are actually buying, and similarly buy where the customers are selling. And so because of that, as a liquidity provider, it's important for us to be able to be out there wherever there are customers. And there's a lot of customers in crypto, and they're not very centralized. As you might expect, a pretty decentralized space. And that applies to the jurisdictional and sort of exchange ecosystem as well. And you have, a lot of this is cultural. You have, Chinese users on Chinese exchanges. You have American users on US exchanges, Koreans on Korean exchanges. Some of this is legal or regulatory. Some of this is where people get banking hooked up to their exchanges. And some of this is which products people demand and which exchanges have those. But because of this, you have a lot of isolated pockets of trading on different venues. And we want to be there to provide liquidity on all of those to the customers on each one.
How come you were interested in being a liquidity provider? Because you can trade arbitrage opportunities without necessarily being a liquidity provider. Like, those are kind of two separate things, right?
So I actually think that they're pretty interrelated. And, sometimes people use liquidity provider to refer like very specifically to someone who has a market making agreement, where they'll have like a certain number of orders out at all times or something like that. But I think there's a more generalized version of liquidity providing, which just means being there wherever liquidity is demanded, being there to provide to customers wherever customers come. And if you think about what are you doing when you do an arbitrage, you're buying low and selling high. Well, why is it higher in one place than the other? If you're buying on Bitstamp and selling on Coinbase, why is there a higher price on Coinbase than Bitstamp? Well, there are a lot of possible reasons, but actually probably what's going on is some combination of, there are customers who are excited to buy on Coinbase, or there are customers who are excited to sell on Bitstamp. And actually providing liquidity to those customers is often exactly the same thing as doing that arbitrage. Both of those are another way of saying you're selling to the customers bidding up Bitcoins on Coinbase and buying from the customers selling their Bitcoins on Bitstamp. And by providing liquidity to those, two sort of imbalanced supply and demand venues, you are actually completing the arbitrage. And most arbitrage arises because of something like this. Some place where there is an imbalance in liquidity demanded between two different coins or venues or platforms or derivatives or something like that. And you're kind of providing, sell side to the buyers and buy side to the sellers. And probably the buyers are driving up the price, the sellers are driving down the price. And so you probably have done an arbitrage when you did that.
Okay, so I guess when I think of a liquidity provider, like the first thing I think is they've got, bids stacked on one side and offers stacked on the other side, providing liquidity.
Yeah, and we do a fair bit of that as well. But again, I think these things are actually somewhat related. Like, let's say we've got a lot of bids stacked on one side and offers on the other. And now a customer comes in and lifts one of our offers. Well, that offer probably was above what we thought a Bitcoin was worth, which means that probably we can go buy Bitcoin somewhere else at a slightly lower price, or at least that's our hope. And if so, we've just done an arbitrage where one leg of it was the liquidity providing. And so I think that, if you're providing liquidity successfully, you're probably doing arbitrage at the same time. And the flip side of this is, and this is a little bit trippy, but I think it's basically true. People always think about the liquidity provider and the arbitrager as the one who's making, and the customer is the one who's taking. But imagine that, instead of offering a Bitcoin at $13,005, I offer a Bitcoin at $13,006. Then a customer places a bid at $13,005, and I sell to their bid. Is that really that different than if I just had that Bitcoin offered at $13,005 in the first place? Like, it's sort of the same result, but we flipped who's making and who's taking. And now you can get rid of the 13,006 offer if you want, and it's still sort of the same. And what you end up seeing is that, there's actually a really thin line between making and taking when it comes to providing liquidity. And, you could have had a lot of offers out for them to lift, for customers to lift, or you could wait for them to place their bids, then hit their bids at the same price your offers would have been at. And sort of both of those are providing liquidity to the customers. And similarly, both of those are, probably you think you can do some sort of arbitrage with them. And so I think that, while it is generally the case that liquidity providers are the maker and customers are the taker, that needn't be true. There are places, and in fact, there are a lot of places in traditional finance where for various marketing reasons that's not true. And the customers are the makers and the liquidity providers are the takers. And it's actually quite similar of a dynamic.
I think what might be interesting is if we could maybe go through, as a liquidity provider, as how you trade, how you would react to maybe certain scenarios.
Yeah, absolutely.
I guess like this video I mentioned earlier, where there was a huge sell wall on a particular exchange. I mean, what are you doing in that situation? I know someone can just go watch the video for a much deeper explanation, but obviously there's large sell walls or buy walls, vice versa. It doesn't really matter. But when you see something like that, how are you reacting?
Yeah. So, the context here is someone sold about $100 million of Bitcoins on Binance the other day. And they did it by just placing a giant offer for, $100 million. And so, how do we react to something like that? Well, I would say a bunch of things go through our, sort of think about a bunch of things at once. One thing is, who is providing to this customer? And that's sort of the liquidity providing side of this. Someone just tried to sell $100 million and they probably can't just place an offer and immediately get lifted at the current market price. I would not be excited to take on a $100 million position at the current price and then have to figure out how to get out of that. So what's probably happening is they're driving down the price. Whether that's happening because, and there are a lot of ways you can imagine that happening. They just keep lowering their offer until someone lifts it, or they just send one giant offer at a very low price at the beginning. But either way, there's sort of this auction almost where they're auctioning off, 10,000 Bitcoins to whoever's willing to bid the most for them and seeing how low they have to go to get those buyers. And so the first thing that I think about is, well, should we be one of the buyers? Are they offering these Bitcoins at a price where we actually just want to buy them from the customer? And if not, what price do we want to buy them at? Like, at what price are we like, yeah, we'll just buy those? And in this particular case, actually, they placed their offer low enough eventually that we did definitely want to buy them. And again, you kind of see this relationship between taking and Friday there, where there weren't enough bids out to fill this order. So instead, they just placed it as an offer and waited for the liquidity providers to come in and take their very low offer for the Bitcoins. So the first thing is, do we want to buy this? And once we decide yes, the second thing is, well, can we? And the thing in crypto is that you don't have one balance sheet. You have a separate capital pool on every exchange. I can't spend my dollars on Coinbase to buy a Bitcoin on Binance. That doesn't work. So the next thing we need to do is get a bunch of capital over to Binance to buy this with. And in particular, the seller was selling it for what's called Tether USDT, which is a US dollar-based stablecoin. So the next thing we need to do is get a lot of Tether over there to buy these Bitcoins. And that's sort of a somewhat crypto-specific phenomenon of completely fractured capital bases. And it really matters where physically your assets are, and you need to get them in the right place in order to trade. So the next thing we're thinking about is, all right, we want to buy this. Now, physically, we have to do that. So we have to ship a lot of Tether over there. And well, first we got to find a lot of Tether. So, one of our trains of thought was like all of the different pieces that we needed to put in place in order to be able to buy these Bitcoins. The flip side of this is that, we want to hedge this trade. We want to find some ways that we're not very exposed to Bitcoin price. And so on the other side, we're thinking, well, okay, we know we're buying a lot of Bitcoins right now. Where are we going to sell? And so at the same time, we were thinking about, okay, here's all the platforms we're on. Here's sort of our thought of all these products. Given all that, putting it all together, what's the best thing we can do given both sizing and pricing and things like that. And so simultaneously, we were trying to decide, what are we going to sell? Where are we going to sell it? And what do we need to do to be able to sell the size that we need there? And so those were sort of the first two things that we were thinking about there. And then maybe the third thing that we were thinking about is, what does this mean for markets? Like, what's this going to do to Bitcoin? What's going to happen when they place this order? What's going to happen when it goes away? Like, is Bitcoin going to go up, going to go down? And that's a complicated question. You're never going to be sure, but sometimes you can kind of get an instinct on that.
Okay, so I guess maybe a silly question, but why did you want to buy this? I think you said that the offer moved down maybe a couple prices to an area where you became interested. But why were you interested in taking this offer?
Right. So I think there are two ways to think about this. The first is we just looked at what price it was at, and it was trading 2% lower than all other Bitcoins in the world. So there was just an arbitrage. And buying this and selling Bitcoin somewhere else, you just made 2% on that trade. So that's sort of the most straightforward answer to your question, is we waited until it was offered lower than other Bitcoins and we could do an arbitrage. And then we did that arbitrage. Maybe another way to approach this, though, is that it's not surprising that happened. Because this guy really wants to sell all those Bitcoins. He's going to have to keep moving those Bitcoins down and down and down until we want to buy, or until people like us want to buy. And so it's sort of not surprising that ultimately his offer settled in a place where it did make sense for us to buy, because that was the thing that stopped it from going even lower, was that we bought it up. And in fact, it wasn't just us, it was us and many people like us all sort of racing to get their Tether over to Binance to be able to buy these Bitcoins. And so he kept moving it down until he hit the price where we would be able to make money buying it and selling somewhere else.
Right. So once you've just taken all these Bitcoin, you have a pretty heavy long position. What's your next step from there? I guess you're immediately looking to see where you can sell these and offload them on different exchanges?
So we do it actually at the same time. And so it's not so much that we buy all the Bitcoins and then we're like, all right, what are we going to do with these Bitcoins? It's as we're lifting this offer, we're simultaneously selling in other places.
Okay.
And that also gets back to the capital thing. Obviously, they're not the same Bitcoins, right? They can't be, because those Bitcoins we're just buying on Binance against it takes half an hour to get them anywhere else, just as blockchain time. So we have to have other Bitcoins in other places that we can sell, or some derivative product or something, some way to be able to hedge this trade. And as we're buying these Bitcoins, we're selling in other places.
Okay, so you're buying into this large sell wall offer on Binance. Meanwhile, you're stacked on the offer on a bunch of other exchanges around the world.
Exactly.
Okay.
Yeah. And now, again, you can kind of see why it's an advantage to be on a lot of different exchanges. Like, all of a sudden, we want to source a lot of sell side, we want to be selling a lot. And we want to be able to source as much liquidity for that as possible to be able to hedge this trade.
Okay. So what about, just another example I'll throw your way, what about in a fast-moving market? Like, as a liquidity provider, as a market maker, my basic understanding of it is that it's easier to make a market where, there's a lot of sort of two-way flow. If it's just a fast-moving market in one direction, a lot of the flow is sort of one-directional. Obviously, buyers are very aggressive. How are you reacting in an example like that? Like, are you just pulling your offers out of the way, or what do you do there?
Yeah, it's a good question. And I think I would flip this on its head a little bit. And what I'd say is that, sort of by default, it's easier to do this in a calm two-way market than some sort of frenetic buying environment. But because it's easier, anyone can do it. And in fact, you won't find many opportunities, because it's just people are going to compete the spreads till they get to zero. Everything's going to be static. And if there's some arbitrage, we'll just come in and tighten it up till it's gone. Whereas in a very fast moving market, because it's harder, because it's more chaotic, that also means that there are a lot of opportunities if you can fight through the chaos that other people haven't managed to get to. And so I think the way we think about it is not that it's a better environment when things are calm. We think it's better when things are chaotic for us. And the reason is we think that we're, one of our relative strengths is understanding chaotic environments, is understanding, well, how do we price these assets when everything's moving? It's not like a Bitcoin's just been trading at $8,000 for the last month, and we buy at 7,900 and we sell at 8,100. Like, no, things just move 5% the last minute. But actually, not everything moved 5%. Like, everything's moved a different amount. And there's dislocations everywhere, and liquidity is really thin. And now, given all that craziness, we have to decide what we're going to do. And so a lot of what we've been doing over time is building up systems that use a variety of quantitative models combined with sort of human intuitions and real-time adjustments to attempt to still be able to do good trades and understand what's really going on, what things are really worth, while everything is flying around and prices are skyrocketing or crashing, and there's huge one-way flow. And that's where you see larger opportunities and larger arbitrages, exactly because they're harder and they're only going to be there for a few seconds, and only if you can realize exactly what this thing is worth, even when you're getting a lot of conflicting signals.
Right. Okay. So what would you say is like the biggest risk as a liquidity provider in the crypto market? Like, what's the biggest risk to you guys?
Yeah, and I think that like risk can mean two different things, and we sort of split it up very much between these two. One sort of risk is like the risk that we just don't make much money. And to that extent, what are the risks? Well, obviously more competition is one of them. Us just doing a mediocre job, I think, is probably the biggest. It's, this is a really complicated, messy environment, and you can only do these trades if you get a lot of things right. And if we just kind of half-ass it, and we're like, I don't know, it'd be nice to have this bank account, but it's a lot of work. Let's not bother. Now all of a sudden some great trade comes up, but you can only do it if you can send money to that bank account you didn't bother getting, because it seemed like a lot of work. And now you're not making money. So I think that's sort of maybe our biggest risk in terms of just like, why would we stop making money? The answer is we just are kind of lazy, just don't do a good job and we'll stop making money. Like, it's not like we just have this machine we can turn on and it's going to print money forever. Like, we need to keep innovating, keep working hard, keep refining our systems, keep refining our internal intuitions about what's going on, and keep getting better every day. in order to keep up and to keep growing. So that's one way to think about it. Then the other way to think about it is like, what's the biggest risk for us losing a lot of money? And on that, well, there are a few big ones. I think exchange hacks are obviously one of these. And so, we have to be really mindful of like, where are we putting our assets? Do we really want to have, $20 million sitting on Quadriga? Like, that probably wouldn't have gone so well. So, being smart about how much you're putting where, managing your risk. And then there's another one of like, do you just do something totally crazy? Do you decide, let's get long $200 million of Bitcoin, hopefully it'll go up? Well, it's fine if you got $10 billion and a mandate to take risk. But if you don't and Bitcoin crashes, you just lost a lot of money. And so I think we kind of think about this, the large risks as like, one of them is like somehow like, an exchange loses our assets. And the other is like, we just put on positions that we have no business putting on that are way too risky, and we get unlucky and lose to them.
Something I did want to ask you, and I think this ties in here, is, you said the word systems, and it just made me think of this. To what extent are your trading decisions discretionary versus model driven? I know there's obviously certain instances like what we spoke about before where there's a large sill wall on an exchange and you're talking about sort of taking that. But just on a more regular sort of normal trading environment?
The answer is somewhere in between. And in particular, almost all of our volume is done by automated systems, but they're automated systems with heavy amounts of real-time manual input. And so we have, quantitative traders 24/7 monitoring all of our trades and adjusting parameters. And rather than thinking about our automated systems as some sort of like brilliant black box that can outsmart all humans or anything like that, we think of them as like a really dumb human that can do 100,000 things at once, almost. And, the reason that we need automated systems is we want to be trading on, thousands of markets, and we want to do it quickly. And we want to be computing a lot of things on the fly, and those are not things humans are good at. But fundamentally, our systems are just doing what our traders tell them to do, just like really quickly. And so, in the end, if they're doing a trade, probably it's because we decided that that trade would have been good. And if there's a trade they don't do, it's not because our systems suck. It's probably because we didn't realize that was a good trade to do, and so didn't tell them to do it, or didn't give them the tools to figure out that that would be good. And so, a lot of our trading is somewhere in between. It's done by automated systems, but it's very human legible, and it's done sort of with real-time monitoring and input and feedback from humans.
What might be an example of parameters that you adjust kind of on the fly?
Yeah, so I'll give you just some of the most common ones. And one of these is, what should our positions be? We stay pretty hedged. We're not putting on huge positions, but we do put on small positions. And, we have traders actively thinking about should we be, long $50,000 of Ripple right now? Should we be, short $100,000 of ETH? And we have parameters to sort of instruct our systems to do that. So that's one set of parameters that we look at a lot. Another set is how much edge should we be looking for? Should our systems just do a trade if they think it's really marginally good? Or should they wait till it looks extremely good before doing anything? And how should that depend on the coin, the environment, the exchange, the price currency, what we've been doing recently, a whole host of factors. And we're tweaking those frequently. There are parameters about, if we're providing, how large do you want to provide? Do you want to show 100 Bitcoins at this price, 50, 1,000, 2? That's sort of another parameter that we'll be sort of pretty actively thinking about. And then maybe one last thing that I'll just mention is capital management. Again, because exchanges don't share capital bases, you need to be physically moving your stuff around to trade. And so we have pretty heavy, human input on where all of our assets should be, so that we're kind of set up to do the trades we want to do.
Okay. That's really interesting, actually. That's I appreciate you sharing that insight. Now, you did mention hedging there, and you've mentioned it a couple times, and I guess I've kind of glossed over it to this point. And I should ask you about it because it's such a big part of what you do.
Yeah.
Just talk to me a little bit about how you are hedging and why there's the need to hedge, how you actually hedge. Yeah.
Yeah. So the first thing that I'll say is that, we think of hedging as accomplishing two different goals. One goal is risk, and the other goal is expected value. And maybe I'll start with the second one. Sometimes when you hedge, it's not because you're worried about the risk. It's because you think you have a bad position, right? Maybe you buy a bunch of Bitcoins. You're like, I think Bitcoin's about to go down. I'm long. That's bad. And you probably want to hedge that position. You probably want to sell somewhere. The second is, I got 100 Bitcoins. I don't really know if it's going to go up or down. I don't have a particular opinion on that. So I could easily win or lose to this position. But I just don't want that variance. I don't want that volatility in my profit. I want to be clean. And the first you always want to be thinking about. And so one thing we often think about is like, do we have toxic positions on? Like, do we have positions on that we're actually going to probably lose to if we don't hedge? And the second is more a question of what's our risk tolerance. If we buy $10 of Bitcoin, we don't need to hedge that. We're fine taking that, 50-cent P&L swing. But, if we put on $1 billion position, there's a 50% chance we're just out of business tomorrow. And even though in the other 50% we make a lot of money, we don't want to take that trade. So we don't want to go out of business. And so, the second way that we think about hedging is like, if we risk too much, we might endanger our firm's ability to continue operating and to continue trading. And that would be really bad. And so for that style, what we're thinking about is like, well, what scales that matter at? Like, how big of a position can we put on before we have to start thinking seriously about this? And probably you want to not get to the point where you have to think seriously about it. Probably you want to have put on a substantially smaller position than that. And in order to do that, even if we don't think Bitcoin's particularly going to go down, the more Bitcoins we buy, we got to start selling. Then moving on to how do we do it? Well, we have a bunch of different ways. There are a lot of platforms in crypto where you can do margin trading of one sort or another. And we basically take advantage of all of those and try and figure out dynamically, sort of at each point in time, what's the best hedge for our position? What hedge do we think we're going to make the most money, or at least lose the least money putting on?
Okay, so just one of the scenarios that you mentioned there, I'll pick up on that. So you said that you were long, let's say 100 Bitcoin, and you didn't really have a view on where it was going, but you felt as though it wasn't a position that you wanted to lose a lot of money on.
Right.
So you might hedge that position. So how are you actually hedging that? Like, what are you doing to hedge that?
Right. So obviously the most obvious thing you could do is send those Bitcoins to Coinbase and then sell them for dollars. But that's kind of a shit way of doing it. Among other things, you have to wait an hour before you can hedge. And maybe you'll lose in that hour. And also, it's going to tie up all of your capital, and you're going to be limited to the liquidity on one exchange and, a bunch of other things. And so, what are ways you can hedge? Well, that is one way. You can, if you're long, you can find Bitcoins you have lying around and sell them on some exchange for dollars. If you're short, you can find dollars you have lying around and go send them to exchanges and buy Bitcoins with them. But there are other things you can do too. So maybe you could go trade futures somewhere. You could find, on BitMEX, there are Bitcoin futures products. CME has Bitcoin futures. OKX, Huobi have Bitcoin futures. There's a bunch of these lying around. And you could do a margin trade on one of those where you post some collateral. And if you're long, you could sell some Bitcoin futures. And now you've got some Bitcoins and you have a short Bitcoin future position to hedge it. And those aren't exactly the same thing, but they're pretty related. And, eventually those Bitcoin futures are going to expire to the price of a Bitcoin. And so, you're no longer really exposed to Bitcoin going up or down. And so, we look at a lot of futures platforms. We also look at places where you can margin trade spot. So, a bunch of Chinese exchanges have ways that you can put on a leveraged position just on Bitcoin versus Tether. Kraken has some Bitcoin US dollar margin trading on it. Bitfinex has margin trading. And, sort of throwing together all of these different venues, there are a bunch of places that you can, get longer or shorter cryptocurrency exposure without needing to send those same physical Bitcoins over there to trade.
Right. Just continuing with this same scenario, where you're long 100 Bitcoin, you're not really sure where it's going to go, you don't have a view on it. You also have the view that you don't want to lose much money on the position. Why would you choose to hedge that position rather than just sell back into the market?
So we would consider that a way of hedging. If you're long 100 Bitcoins, you just bought 100 Bitcoins, one way to hedge it is to sell those out again. And that would work. And so then the question is, why would we do something else instead of that? Why don't we just sell our Bitcoins? And the reason is, well, let's go back to this Binance example, right? Someone just sold, 10,000 Bitcoins on Binance. We bought a bunch of them. Well, the reason we bought them is that the Binance Bitcoins were really cheap. They're trading at a low price because of the seller. And if we wanted to get out of this risk by selling those Bitcoins, you'd be selling them back at that same low price. And it would defeat the whole point of having done the trade. And, in general, when you're sort of doing arbitrage, probably if you just sell out in the same market you bought in, you're going to lose all of your arbitrage gains. And what you want to do is instead sell on the higher markets, sell on the places that didn't have this big seller driving down the price.
One of the things I do find very interesting about you and what you've been able to achieve with Alameda Research is the fact that you've only been going for 2 years. And it seems like you've just really grown at an exponential rate. I mean, what do you think is I don't want to use the word secret, but what's been the driving force behind that?
Yeah, I think the answer is sort of working hard. I mean, it's sort of a lame answer, but I think that there's a lot of truth in it, the working hard and hiring good people. I don't think that we have this, one weird trick to grow your company in 2 years or anything like that. I think it really is just like, we threw together a lot of really impressive employees. I'm like extremely happy with our team. And we've just really been plugging away. Like we've been, and it's not just we've been working long hours, but we've also just been trying to hold ourselves to a really high standard and not feel like, we made a successful business. That's what we're going for. We're done now. Instead, just like, but it could be bigger. It could be better. And however much we've done, there's always way more to do. And every single day we build on that. We build more tools. We build more models. We throw out models that don't make sense anymore. We think of more trades. We get onboarded to more venues. We get more, bank accounts and entities. We hire more people. We build more relationships in the space. And we just keep going at this. And we make sure not to get complacent, not to stop. And we try and be self-critical about it. We're not like, we don't congratulate ourselves for everything we do. We fuck up sometimes. And when we do, we try and figure out, what did we do? Like, why didn't this work? Maybe we just got unlucky, in which case that's fine. That happens. Shit happens. But maybe it wasn't luck. Maybe we kind of could have realized this would have happened. And then we should figure out, well, what underlying mistake are we making? Like, what's sort of the thing that we should be changing about, about our models or behavior or understanding or anything like that, that would, have caused us to not do this. And so I think that that's one big piece of it. And, kind of pursuant to that, we've kept going forward. And, we've built out a pretty big trading operation. We're, something like 5% of global crypto volume at this point. But, we also haven't stopped at that. And so, we ventured into the OTC space. We built an electronic OTC trading platform where users can get 24/7 automated quotes. And then a few months ago, we released FTX, which is a cryptocurrency derivatives exchange. And kind of similar to the Alameda trading operation, we're seeing this as a product we really want to make the best, make it as good as we can. And we're not just trying to release a thing that is a derivatives exchange. We're trying to release the best derivatives exchange. And we're going to keep iterating, keep releasing new features as quickly as we can, keep taking feedback, understanding what we can change about it so that it is the platform that people want to use, that fixes all of the issues that other platforms have in this space. And I expect us to be releasing more and more things going forward. And, for Alameda to keep discovering, more and more ways to trade in crypto. And maybe one last thing I'll say about this is, I think one piece of this about not sort of getting complacent is that I don't know. I sort of originally came into this space with the goal of donating, with the goal of making what money I could and then giving it away. And the interesting thing about that is that if you're just a human buying cars or something, there's a lot of very, very compelling evidence that beyond a certain point, money doesn't really make you any happier. You've got a perfectly comfortable life. The next $1 million isn't going to do very much for you. Maybe your car gets a little faster. But when you look at the scale of the world's problems, it's massive, right? There's, thousands of people dying of preventable causes every day. And, all of a sudden you're not talking about how much could you spend to make one person's life better. You're talking about billions of people's lives better. And just the scale of funds that you can deploy to that are massive. And, it's like you're talking about like $1 billion to really fix some really large problem in the world, like, people dying of malaria or, and because of that, like, it sort of didn't make any sense to stop scaling Alameda once we, become reasonably big. It kind of has felt pretty naturally like there's always more that we could be doing. And we sort of have the mandate to always do, push forward as far as we can.
Yeah, that's a really respectable answer, man. I think that's
thank you.
That's very good of you. Now, just to take things out here, I guess I should ask you if you have, a longer term view on the crypto market, like a macro view on, where you see things moving forward over the next couple of years. I don't normally like to ask these sort of questions, but I feel like in the crypto market,
you sort
why
of have
not?
to.
Yeah, and I'm sure you've got some opinions on that.
Yep. So I do have some opinions, although they might not be as exciting or extreme as could be. I think basically that it could go either way. Sort of the boring answer. Like, I think that you could imagine a world where crypto is just fucking huge, and you could imagine a world where it just kind of whimpers away. I think both those are possible. And I think one question is, well, what are the odds each happen? And they actually both seem pretty plausible to me. Like, it's not just possible, like really could happen. Like, you could imagine crypto really taking off. It's already kind of gotten an enormous share of the world's attention. And you could also imagine the world just saying, like, yeah, this is kind of stupid. Like, why do we think so much about this? It's kind of electric money. The US dollar is totally fine. We're just going to stick with that. And what's going to determine that, I think, well, it's a lot of things, many of them probably pretty chaotic and random. But one thing is, can the space get its shit together? There's a lot of pretty broken things in crypto right now when you scratch beneath the surface. Exchanges that have lost hundreds of millions of dollars to poor risk controls. You have the inability to actually move your money around between the platforms, which is ironic for an asset whose whole point is you can move it around easily. You've obviously had a lot of scams, and beyond that, you've had a lot of ICOs where sort of the approach was, let's create a coin, let's sell it, then let's maybe create a company, or maybe not. We'll sort of see about that last one. And all of these things, you say, like, why isn't the institutional money flowing in? Well, you get a Goldman, you're like, all right, so here's the deal, guys. This exchange lost a few $100 million last year. It's going to charge you, probably millions a year in fees. And you can only get $1 million a day out of it. And 3/4 of the products listed there have no company associated with them and somehow have $100 million market caps. And I don't think Goldman's going to be like, yeah, that's our bread and butter. They're going to be like, what the fuck? No, we're not going to touch that. And so, I think that, like, a lot of what will determine this is, can this space really, I don't know if professionalize is quite the right word, because you also sort of want to retain its, innovation and all the things that made it kind of take the world by storm, but can it maybe do that, but cut out the bad shit? And I think that's going to be one big piece. And I'm going to just say one other thing on this, which is, what's a Bitcoin worth? Sort of an interesting question. I don't know. I certainly don't know. But when I've tried to think about this, I've gone through thought experiments like, well, I don't know, which should be bigger? Which should have a higher market cap, like Bitcoin or like, the currency of Estonia or like Poland? Or how about like Australia or Taiwan or the United States or the euro? Like, where would you slot Bitcoin into that? And so you can kind of guess, like, well, I don't know, like about which country do I think about has, about as much power in the world as crypto? Another approach might be, what are the odds that Bitcoin is the new euro, that like in 20 years, like, 20% of the world's using it as their primary currency? You can try and think about like, how does it compare to gold? Like which, if it's gold to become a store of value, like gold seems like kind of the standard there. And those are sort of three different ways to estimate the value of a Bitcoin. And, they're not easy, but I think you can actually get like some plausible ranges from that. And I don't know, whenever I try and do it, I get ranges somewhere between like 1,000 and 100,000. And that's obviously like a huge range for the price of a Bitcoin. But it's worth noting we're at 10,000 right now, which is sort of, the geometric mean of those, which makes me feel like, I don't know, the current price is pretty plausible. It doesn't seem obviously too high or too low. And that, it doesn't seem to like, obviously it's going to go up from here or obviously it's going to go down from here. It seems like, yeah, either could happen depending on whether it does move closer towards achieving that goal of becoming the euro or gold or something like that, or whether the world just kind of decides, well, this is kind of a cesspool. Like, let's just forget we ever did that.
I think that's a really interesting answer given how invested in the space you are. And I don't mean invested as in like you're 100% long Bitcoin or any crypto product.
Right. But obviously my businesses are extremely long the space, even if they're not literally long, because the bigger the space is, the more business there is for us to do.
Yeah. So I think it's interesting that you have a very neutral view on the macro outlook of the crypto market.
Yeah. And I think one thing I will say is, I do think the upside is maybe higher than the downside. Like Bitcoin, I don't think it's going below zero. That'd be a little bit difficult, but it could more than double. And I think like, people often use this argument for stocks and it's kind of stupid, but for Bitcoin, I think it's real. Like it couldn't, more than just double, like it could 10x. And so I do think that there's a pretty plausible argument of like, well, kind of 50-50 on whether it goes up or down, but if it goes up, it could go up a lot. But I don't believe that extremely strongly. And I don't feel like it's just like obviously Bitcoin's going up.
Yeah. Okay, man. Well, let's leave things there. Like I said, I have a ton of notes here, and there's a lot we didn't even get to. But maybe we should try and line up a part 2 at some point.
Absolutely.
Because I've really enjoyed this. It's been I've found it really fascinating to get a bit of an insight to how you guys are running your business over there.
Thanks. I've enjoyed this too and would be excited to go for round 2. Yeah,
cool, man. If someone wants to follow you or just get a bit more info, learn a bit more, you're on Twitter?
Yep, so you can find me on Twitter. I'm SBF_Alameda. You can find AlamedaResearch.com or Alameda Research at, Alameda-research.com. And you can find FTX, our derivatives exchange, at ftx.com.
Okay, and your OTC business, is that all through Alameda? That's not a separate sort of spin-off?
That's right. So actually you can do it through either Alameda Research or FTX. They both have the same platform on it. And both FTX.com and Alameda-research.com have links at the top to the OTC portal.
Okay, good one. I'll include those links in the show notes as per normal, and I'll also include a link to the video that you posted while you were live trading the other day.
Sounds good.
Because I think that's worthwhile everyone checking out. So I'll put that link in there as well. Sam,
awesome.
Again, I really appreciate this. Thank you for taking an hour out of your evening to speak with me. It's appreciated.
Of course. Thanks for having me.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.